Should you stay in the market? Should you sell? Should you buy the dip? What's going on right now? Lots of volatility. We go up, we go down, we go up, we go down even further. Lots of headlines there, scary headlines, lots of headwinds, tariffs, job reports, cuts here, Doge, etc., etc. So lots of questions, lots of uncertainty, and of course we know that the stock market does not like uncertainties. Now, there's one investor, analyst, whatever you want to call him, Tom Lee. He's coming out every other day talking about how bullish he is, right? He thinks that the market should be bottoming out this week. Well, at the time of making this video, I don't really see that happening anytime soon. But the important point of what he's been saying is that staying invested makes way more sense than trying to time the market and the bottom and whatnot. I'll explain and I'll show you a couple of examples in this video. And for those that are saying that, oh, we are in a huge bubble, also, I'll show you some examples from some big companies that are trading at quite attractive prices right now. So no, I don't think we are in a bubble. Are certain companies, certain teams in a bubble? Maybe. Definitely in the private sector, right? In the private market, I think there is a huge AI bubble. In the public sector, I don't think so. In the public market, should I say? I don't think so. Now, you might disagree. That's up to you. But when I see an OpenAI being valued at around $300 billion, and then I see some publicly traded companies that are also related to AI, GPUs, and all of that, that have a market cap that is much smaller than that, yet they generate more revenue and more profits, I see the AI bubble in the private market and not in the public one. Now, touching back on what's going on right now in the market, just so we're clear here, usually when you start to correct something, whether it's an addiction, weight loss, you want to train for a marathon, etc., etc., what's the most painful and difficult part? And that's actually something in life, right? There is not one thing worth having if you're not suffering a little bit, if you're not putting in the effort a little bit towards getting through that goal. Weight loss, the most difficult part is at the start. Training for a marathon, most difficult part is at the start. Detox, most difficult part at the start. Spending, right? Cutting your spending, cutting the fat. The US government spending has been, you cannot go on like this, right? We know, oh, we look at the stock market, oh, how can they dare do this, right? You're hurting my portfolio. Well, trust me, if they continue to do what they've been doing the last couple of years, it's not just one administration or the other. It has been going on for a long time. Your portfolio will not matter much when the US will go bankrupt. And this is the path that they're going through if they do not cut spending drastically. And of course, when you start cutting spending drastically, when you start cutting across the board quite aggressively, because you want to do this as fast as possible, right? It's like pulling a band-aid. You don't want to do this slowly because this just doesn't make sense. You pull it once, it hurts at the start, but then it's over. It's the same thing here, in my opinion. Of course, with the tariffs, it's really flip-flopping in the last couple of days. There are tariffs, but then no tariffs on those products, and maybe there is a pause until April, and then maybe we'll come back and we'll see what happens. So yeah, lots of uncertainties. But if we zoom out a tiny bit, right? I know I've been rambling around for a couple of minutes now, but I'll make my point. If you look at what has happened, in the last year or so, right now, and this is the S&P 500, right now, as you can see, we're down, just over 7.5% since the recent all-time highs. Right, we're also under the 200-day moving average, so that's something to look out for. Then if we go back to July of 2024, what happened there? Well, we dropped close to 10% in a matter of a couple of weeks. Then if we go back even further, back here in 2023, August, July 2023, what happened there? Also a drop of 10.7%. We also went under the 200-day moving average. But what happened since then? Well, look, we went higher and higher and higher. So yes, right now, this doesn't look great, right? Oh, we're down now also year to date. And this, by the way, this is just the S&P 500 that is down 7.5%. I know very well that there are plenty of companies that are down 10, 20, 30, 40%, maybe even more in the last couple of weeks or months. For example, a SoFi is down, 30% or so since the highs from a couple of weeks ago. But guess what? In the last 6 months, it's still up 69%. Yes, I didn't even make that number up. You can look it up. It's up 69% in the last 6 months. So I know there's a lot of panic right now because, oh, look, we're starting 2025, red days, red portfolio, etc., etc. I know, but we've also had 2 great bull years behind us. And I think we're going to have great bull years in front of us as well. It's just short-term volatility right now, short-term pain for long-term gains, because I truly believe that what they're doing right now is necessary. Now, before I continue, hit all the buttons, would really appreciate that. Thank you very much for all the support. We're making our way to 90,000 subscribers. So if you're new here, hit that subscribe button. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. First up, fear and greed index. We're now extreme fear, which means should be buying. Extreme greed should be selling, right? Be greedy when others are fearful, fearful when others are greedy. Credit to Jesse here on X. Then some macro stuff. So February job reports, US labor market adds 151,000 jobs and unemployment rate ticks up to 4.1%, which again is still quite low, well below the 5% range. So yeah, I mean, this is not a negative thing at all. If we look at other data, change in US government workforce, of course, there have been some cuts there. More specifically, if we look at this part right here, federal government sheds 10,000 jobs in February. Now, it's also important to note that I believe 75,000 workers have taken a package to leave, and I think they're getting paid. So basically, their status is employed up until the fall. So those are not calculated in the numbers at the moment. Then there is another part here of this whole unemployment rate segment, which is the underemployed one, which is the folks that want to find a full-time job, cannot find a full-time job, so they're working a part-time job. So we're seeing that right here. This is rising. We're also seeing that US hire rate is coming down, which, I mean, I know a lot of executives have been telling us, look, AI is going to create a lot of jobs, etc., etc. So far, that has not been the case. But this also tells me that we are still in a healthy work and, healthy employment environment, because I much rather see people take on jobs, right? Even if it's part-time jobs, at least you're making money, right? At least you're not staying at home and hoping for the government to give you free money, which is how actually inflation is created, since that's what we've been seeing in the last couple of years. So of course, you'd like to see more and more people find that full-time job, but the fact that they are finding also part-time jobs is a healthy thing in my opinion, because you are making money. You're not going into debt. You are making money. Unfortunately, it's not a full-time job, it's a part-time one, but I guess that's better than nothing. Then touching back on what Tom Lee said, and this is a very, very important part, especially since we started the year with lots of red days. Well, he talks here about the rule of 10 best days, so impact of not owning the 10 best days. Since 1928, the S&P 500 return was 8% on average, excluding the 10 best days would have been down 13%. If you go more recently, since 2015, the S&P 500 return was up 12%. And if you exclude that, that would have been, minus 10%. Then, more recently, you can see exactly what has happened, right? If you exclude the 10 best days. Now, in the last 2 years, this is basically the picture. In 2023, if we look at the cumulative gains, the best 10 days, that's up 20%. The full year excluding 10 best days, 4%. So, okay, it would still be up, but far from the huge performance of 24% for the full fiscal year. Same for 2024. 10 best days, up 19%. If you exclude that, you're only up 4%. So, yeah, a huge, huge difference here. And this is what I'm seeing right now, and this is what we've been seeing. It is not just me saying, you look at the data. Retail investors only like to buy when we are at all-time highs, when things are only in the green and not really when things are deep in the red. And in my opinion, that's a mistake. And I'm not saying that, today is a screaming buy across the board. No, but I do think that you can find a ton of value in today's market. Of course, if you are a trader, then you don't want to catch 49s. But if you are a long-term investor, there are plenty of companies today that are trading at super attractive prices. Nothing compared to what we've seen in 2021, 2022. Far from it, in my opinion. And I'll give you a couple of examples. Let's first start here with Alibaba. Alibaba right now, if you look at the forward PE, it's finally over their, 4-year mean, but still quite low, 14.34. If we look at Nvidia, believe it or not, well below the 5-year, 4-year average here, 24.53. Looking at Alphabet, Google, 19 times forward PE, also below the average. Looking at the Walt Disney Company, well below the average here at 19.1 times. Meta Platform is actually above it, but for a quality company like Meta, 23, 24 times, is that expensive? I don't think so. Netflix has now come back down to around that 4-year average, 35.24, which is of course much, much higher to where it has been in 2021, 2022. Target, another type of company, but very important to know what they're saying and what they're feeling here as well. Forward PE, 12.43, well below the average. Bookings Holdings, another important company that shares quite informative data. Forward PE, 22 times, also below the 4-year mean. And then the last one, PayPal, 13.56, well below the 4-year mean, although we know that, well, this part right here, it was super high because of that bubble, because also PayPal was growing much quicker than today, although today it's more profitable than before. But still, this is what I'm showing you right now. We are far from a bubble. We are far from an overvalued market. There are definitely overvalued companies in the market, but the market as a whole, in my eyes, is far from being overvalued, far from being in that same spot where we've been in 21, 2022. Of course, with macro uncertainties, short term, we're going to feel it in the market, right? We're going to feel that volatility in the market. But for long-term investors, this is exactly when you start making and placing your bets for the future. I am extremely confident in the positions and in companies that I hold in my portfolio right now. And I know very well that we can go lower, all right? I don't love seeing my portfolio come down, right? Some people might think that, oh, red days, you like red. No, I don't like to see my portfolio come down. But I'm also not complaining to the fact that I can buy more shares of great companies that are already owned, because I think, again, this is me thinking, that in the future, as long as these companies continue to perform well, execute correctly, I think they will be worth way more in the future than what they are today. Might not take 2 months, 3 months, like some retail investors think that the market should go up 50% in a year because that's normal. No, but if we go up slowly but surely, over a long period of time, I don't mind. So all in all, that's about it. I know that when you see your portfolio getting destroyed or coming down, it's never nice. Shouldn't panic. I don't think we are in the same spot that we were back in 21, 22, where we're going to enter a huge bear market. I don't think so. And people will say, oh, recession. What recession? Have you seen the data? What recession? What indicates that we're going into a recession? We're far from it, right? If unemployment rate was over 5%, huge layoffs, etc., okay, fine. But so far, nothing. So yeah, that's about it. Do share your thoughts down in the comment section below. I will be going live later today. So if you want to ask specific questions, make sure to join that live stream. If not, I wish you all a very good weekend. Bye-bye.